Well, let's begin at taking a look at how the markets are fared today. Starting the week on a positive note, the All Share Index gained a marginal 0.16% to close at 37,051 and 14 points. The previous week saw banking stocks dominating market activity, with the top-tier banks seeing some pockets of activity throughout the week. Activities in the bourse were lifted by gains in Forte Oil, Cadbury, Canoil, Flowers and PZ, while Mobil, UACN, Webco, First Bank Nigeria Holding Company and Access Bank led market declines. Well, joining me to review the Nigerian equity market from London is Olubunmi Ashalu, Head of Equity Research at FBN Capital, and Oyebola Farinde, an analyst at AGH Capital, here with me in studio. Thank you so much for making the time to join us today, to both of those gentlemen. So let's kick it off and just talk about, trading volumes looking over the past couple of recent sessions have been pretty uncertain. We're also looking at some of the banking activity that will be coming through. But what is your assessment of the type of activity that we've seen on the market? So let's kick it off with London and hear from you, or Olubunmi. How are you seeing market performance there?
Well, in our view, it's just a reflection of the fact that the Q3 reporting season is yet to kick off. So over the next couple of weeks, we believe that we'll see the activity pick up as investors have a reason to make adjustments, buy or sell more stocks. Over the last 2 months or so, there's been a lack of meaningful catalysts. So we expect that to change in the coming weeks.
Okay, well, where would you see activity, or where would you see value in the market currently?
Thank you for having me on the show. Currently, I still see a lot of value in the banks. We have seen reduced activity, partly due to the uncertainty that is coming from external factors. The US budget issue is one, and that is really weighing very significantly on the emerging markets. So Nigeria is not outside of that. But when we look at the banks, we look at the PE ratios at figures less than 10, price to book of less than 1. The opportunities there are still very significant in the banks.
Now, you mentioned those PE ratios because they've been, significantly high. Are they able to, sustain this?
Well, people have come up and said the banks would have a challenging year this year. I won't say otherwise, but these banks are run by very, very good professionals who would look at their numbers and see where they need to restructure and rebalance. Typically, when there's pressure in the top lines, people look at what the different lines are to arrive at the profit lines that will be meaningful to investors. But we also look at it from another perspective, from our firm position, which is that the economy itself also is presenting the banks with opportunity to now continue to lend. The oil and gas opportunities in the market is one that is beginning to grow. The power lending opportunities as well is growing. So the banks, I'm sure, will get creative and find some way of holding up their numbers.
I'd like to shift this question now to Olubunmi over in London. We've seen the central bank had increased their, the cash reserve ratios in the public sector. How is this likely to impact on the profit margins for the banks?
Yeah, I mean, there was quite a lot of noise about this in July when the whole thing started. Yes, there is a negative impact on banks because the funding costs basically go up, and if you were putting those funds into T-bills or FGN bonds previously, you have to basically sterilize them by putting them with the CBN. But I think over the Q2 reporting season, on average, I think the EPS impact across the 9 banks we cover probably was around 5 to 7%. So the headlines make you feel really fearful about what the impact could be on the banks. But I think there's a bit of calming down that's required over the next 6 months or so. I don't think it will be disastrous. I mean, yes, it will take off some EPS growth from the banks, but it's nothing to cry about, basically.
Right. Now let's shift gears slightly. I know that we were talking about the market being quite expensive, looking at those those high PEs. But I just want to know from the both of you, apart from those overvalued consumer stocks that we're looking at the moment, which stocks would you consider to be a safe haven? And I will start with you.
Safe haven on the broad market, you say?
And that's right.
Well, I will stay with the large caps. Typically, you're very safe with them. In terms of valuation as well, they're pricey. I'll stay with my Guaranty Trust Bank. Axis Bank, I think I would also want to do. Yes, it's stepping into that tier 1 space. Its management is very good. If I move into the FCMG sector, I would look at the likes of UACN, flour mills, companies that are not extremely rich, but have a diversified revenue base and are kind of mirroring the kind of increases we're seeing in the economy, the kind of growth we're seeing in the economy as a whole.
Well, Bumi, I'll pose that question to you as well. Where would you be looking at those safe investment or safe haven stocks on the NSE today?
Yeah, maybe I'll start with the last stock that was mentioned there. So UACN, more because of a resurgence in the performance post the Tiger Brands or investment or showing up on the scene. That's filtered through to the numbers. If you compare UAC's growth rate across the board with all the other consumer names, it's right up there, top 3, top 5. So at least there's some momentum there. You can't find that or you struggle to find that sort of performance in most of the other consumer names. Within the banks, we have a slightly different view. We prefer Zenith and UBA. Zenith because on a risk-reward basis, it's attractive because Zenith's business model is pretty simple. You may argue that in the long term that maybe they need to change or be a bit more aggressive, but at the moment, you're looking for, as you said, relatively safe investment. So I think Zenith fits that very well. As far as UBA is concerned, it's more a recovery play. Some people are still not very comfortable with UBA, but it's gone up quite a bit in the last 18 months or so. We've been backing it all the way, and we still believe there's still some upside to go because it's the only bank that beyond GT will do more than 20-21% ROE this year, we believe.
Right. Now let's look at things on a macroeconomic picture. Well, I'd like to know from you in terms of your, looking at the macroeconomic environment. The Naira at the moment has regained some stability, but one would say we're not out of the woods yet. What would be some of your concerns based on that?
Well, the central bank has done a lot of work to manage the Naira, to keep it stable. And that is done fairly well. When you look at currencies in the emerging markets, we've seen South Africa lose about almost 15%. India was the most affected currency. But Nigeria is a lot more stable, losing about 2%, and that doesn't really give me much concern when we look at the macros perspective. With these issues in the US, if the dollar keeps weakening, then the Naira can also pick up. But largely, I don't have much currency concerns with Nigeria.
Olubumi, I'd like to move over to you again and just talk about some of the reportings that we're seeing. I mean, the second week of this month, we'll be seeing some of the non-financial companies coming out with their results. And if you look at the second quarter of last year, most of their earnings were a little bit subdued, and this on the back of some of the the weakness in the consumer discretionary that we've seen. Do you think that this trend is likely to continue into the third quarter?
Yeah, the simple answer is yes. I mean, we've not seen any major change in the slowdown, deceleration, or year-on-year declines in for some companies on EPS growth for some time. We expect that to continue. Q3 usually is a seasonally slower or weaker quarter anyway because of rains. So we haven't detected any major shift as far as the consumer is concerned in terms of spending. So our view is that as far as Q3 preview is concerned for the consumer names, it'll be a relatively subdued quarter